What causes the crypto market to pump or dump? In short, it's crypto-specific factors and macro factors. If you know what these are, then you can predict crypto prices with surprising accuracy. This begs the question of which crypto and macro factors are coming up in 2024 and how they could affect the market. A recent report answers all of these questions, as well as a few important predictions. That's why today we're going to summarize this report and tell you what it could mean for the crypto market. Don't go anywhere. The report that we'll be summarizing today is titled Outlook 2024. It was published by crypto research and investment firm CoinShares late last month, and we'll leave a link to the full report in the description if you're interested. Now, the first part of the report unpacks the effects that various macro factors could have on BTC's price over the next 12 months. The authors start by talking about what is arguably a crypto-specific factor, and that is the approval of the spot Bitcoin ETFs. They note that the inflows could take BTC to 60K this year. That said, one could argue that the approval of the spot Bitcoin ETFs is a macro factor because it makes BTC more correlated to other macro factors. That's simply because it makes BTC more accessible to institutional investors who often adjust their portfolios in response to things like interest rates. As we mentioned in our video about BTC's price after the spot Bitcoin ETF approval, BTC's price action will therefore depend on how these institutional investors see BTC as an asset. In this case, the authors imply that institutional investors see BTC as a safe haven asset, comparable to gold, which makes sense. There is just one caveat that the authors underscore, and that is that institutional investors love safe haven assets that earn a yield, namely US Treasuries. In practical terms, this means that BTC and gold will compete with US Treasuries for institutional inflows and will only win if the Fed lowers interest rates. Newsflash, but the Fed is expected to lower interest rates significantly this year. Logically, this will increase institutional preference for BTC and gold over Treasuries, which will be bullish for both assets. However, interest rates aren't the only macro factor at play. The US dollar is another related factor. As some of you will know, BTC's price is inversely correlated to the US dollar, as measured by the DXY. In plain English, when the US dollar gets stronger relative to other currencies, then BTC's price goes down, and vice versa. However, the authors noted something odd. The correlation has been positive lately. In other words, BTC has been rising alongside the US dollar. The authors seem to take this as additional evidence that BTC is seen as a safe haven asset. But it could just as easily be due to the hype around the spot Bitcoin ETF approval. Regardless, the authors believe that this correlation will invert again in 2024. Assuming the US dollar weakens, then this will be bullish for BTC. The caveat here is the DXY. Again, the DXY measures the strength of the US dollar relative to other currencies, namely the euro and the yen. If the euro, the yen, and the US dollar all weaken, but the euro and the yen weaken more, then the DXY could still rise. As you can see, there's a lot of nuance here, but that's macro for you. By the way, if you're enjoying the video so far, then be sure to smash that like button and give it a boost. This ties in to the second part of the report, which analyzes how macro factors could affect crypto-related stocks. The authors start by highlighting the fact that the US economy has been surprisingly resilient despite the meteoric rise in interest rates. GDP figures remain robust, as does the unemployment rate. They then recap how Fed Chairman Jerome Powell suddenly became dovish last December. That is, giving signals that the Fed is going to start lowering interest rates. They note that the exception of rate cuts caused by Jerome's comments have been the primary contributor to the market rally we've seen since. However, the authors imply that the coast isn't clear just yet. That's because a lot of companies, including crypto companies, have lots of debt that they need to refinance this year. The authors estimate that around a quarter of publicly traded crypto companies will need to refinance debts over the next 3 years. Assuming interest rates stay higher than investors expect, these companies could be forced to refinance at interest rates approaching double digits. Obviously, this expensive debt could squeeze crypto companies while simultaneously lowering the yields they're currently earning on their cash reserves. Cash reserves are typically held in short-term US government debt, by the way. Anyways, the authors highlight 2 risks that crypto stock investors need to be on the lookout for. The first is the possibility of a recession, and the second is a resurgence in inflation. The former would result in significant economic weakness, while the latter would result in interest rates staying higher for longer. The authors believe there is a real risk of recession because it takes between 12 and 18 months for interest rates to affect the economy. They note that the last rate hike happened last summer, which means that the effects of the Fed rate hikes may only start coming into play in the coming months. Similarly, the authors believe that there is a real risk of inflation if the Fed cuts interest rates too soon. They note that this would cause commodity prices to surge and reignite consumer spending, which would force the Fed to restart its hiking cycle. That is, continuing to raise interest rates higher. What the authors fail to note is that it would likely take time for this inflation to reappear in the official data. Put differently, the Fed cutting rates too soon could be extremely bullish for the markets in the short term. That's because there would be a sort of window where rates stay low and liquidity rises. Given that crypto appears to be sensitive to liquidity, aka money supply, it would be the first to rally, and history suggests that it would rally a lot. If investors are correct in their interest rate forecasts, then this rally could come soon. If you want to make sure you're ready for it, by the way, then check out the Coin Bureau Deals page. It's got trading fee discounts of up to 60% and sign-up bonuses of up to $50,000 on the best crypto exchanges. These deals are only available to viewers of the channel and for a limited time only, so be sure to take advantage of them ASAP. The link is down in the description. Anyways, the third part of this report pertains to an extremely important topic that's been completely under the radar, and that is Bitcoin mining. For context, Bitcoin's hash rate, that is the amount of computing power being used to secure the Bitcoin network, has historically been correlated to BTC's price. Like BTC, Bitcoin mining follows a cycle consisting of various phases. In the case of Bitcoin mining, the authors outline 4. The gold rush, which is when BTC's price is rising, the inventory flush, when BTC's price is falling, the shakeout, when BTC's price collapses, and the rebalancing, when BTC stabilizes. Each of these 4 cycles has a corresponding effect on hash rate. During the gold rush, BTC's hash rate rises. During the inventory flush, it falls. During the shakeout, it collapses. And during the rebalancing, it likewise stabilizes. What's strange is that Bitcoin's hash rate has basically been up only since mid-2021. As far as the authors are concerned, though, they believe the shakeout phase occurred in late 2022, and that 2023 was the rebalancing phase. They seem to acknowledge that this is a bit strange, as the upcoming halving could increase the cost to the point that it takes, and I quote, quite a few big miners offline. For reference, the Bitcoin halving cuts the amount of BTC rewards to miners in each block by 50% every 4 years. The next halving is due sometime in April, and there's growing speculation that this could have a serious impact on miner profitability. From the author's perspective, this could cause the Bitcoin mining cycle to stay in the rebalancing phase until sometime after the halving, and the gold rush phase should begin at the end of this year. This would be consistent with past crypto cycles and set the stage for a blow-off top in BTC's price. This relates to the 4th part of this report, which is about the Bitcoin mempool. For those unfamiliar, the mempool stores pending BTC transactions. miners select transactions from the mempool based on the fees associated with them. The higher the fee, the faster the transaction gets included in a block. In the past, miners would start by processing the transactions with the highest fees in the mempool and work their way down until they've processed all the pending transactions. In the present, however, there are so many pending transactions that the mempool is constantly full, resulting in very high fees. The authors note that this has never happened before, at least not for such a sustained period. Of course, it's all due to the hype around the recent innovations on Bitcoin, such as BRC20 tokens and ordinal NFTs. The authors note the hypocrisy of the criticisms of Bitcoin given the circumstances. For example, some have argued that low mempool use means Bitcoin is bad because it's not being used, while simultaneously arguing that the mempool being maxed out means that Bitcoin is bad because it's being used too much. The authors effectively advise these critics to leave the free market that is Bitcoin. Another arguably anti-Bitcoin argument has been that it's not earning enough in terms of transaction fees to keep the blockchain secure. To their credit, the authors actually go into the effort of calculating what the average transaction fee would be for Bitcoin to maintain its incredible security. In the end, they conclude that it's actually not possible to know this, and that it's likely a theoretical problem. They stress that Bitcoin's security has never come into question since its inception because BTC's price has been steadily rising due to the decrease in the new supply and the increase in demand. Even so, they admit that Bitcoin's high fees probably won't be going away anytime soon. And this is likely to have profound impact on Bitcoin's ecosystem. For instance, high fees on the Layer 1 chain are incentivizing the creation of Layer 2 chains, similar to what we saw in Ethereum's early days. If Ethereum's Layer 2s are anything to go by, it is safe to say that Bitcoin's Layer 2s will have lots of potential. The tricky part will be figuring out which ones will go boom and which will go bust. This is exactly why we created the Coin Bureau Club, to analyze these new and up-and-coming cryptos. Members of the club get to vote on the altcoins that we cover and get to see which cryptos we hold in our portfolios, as well as the coins and tokens that we're watching. Best of all, members get access to an exclusive Discord channel where they can discuss all of the above and more. Did I mention exclusive deals too? You can learn a lot more about that using the link in the description. Anywho, this pertains to the fifth part of this report, which is about the Bitcoin halving. To refresh your memory, the Bitcoin halving is expected to occur sometime in April. The practical effect of the 50% reduction in new BTC supply will be an increase in BTC's price, assuming demand stays the same or rises. However, this reduction in new BTC supply will simultaneously reduce the revenues of Bitcoin miners, which could have unintended consequences for the market. That's why the authors take time to unpack just how much trouble Bitcoin miners will be in when the halving comes and goes. They start by saying that publicly listed Bitcoin miners account for 25% of Bitcoin's total hash rate. They note that lots of these miners did have lots of debt, but not anymore. This is due to a combination of less borrowing as well as miners selling equity to pay back their existing debts. This has been made possible for most publicly traded Bitcoin miners to accumulate large amounts of cash and BTC, while simultaneously expanding the size of their operations. At the same time, the approval of the spot Bitcoin ETFs mean that BTC's price is likely to stay higher, resulting in even larger revenues. In sum, then, the authors believe that the publicly traded Bitcoin miners will not be that affected by the halving. This is interesting, given that it seems to contradict what was noted by the authors earlier. It also runs contrary to a recent report by Cantor Fitzgerald, which found that 11 large miners could be at risk. The bigger question is what will happen to all of the other, smaller Bitcoin mining operations after the halving. It stands to reason that they don't have access to all of the same resources as publicly traded Bitcoin miners. The result could be that publicly traded miners capture even more of the hash rate. Now take a second to consider that asset managers like BlackRock and Vanguard are some of the largest shareholders in the largest Bitcoin mining companies, with these asset managers also operating the largest Bitcoin ETFs. It could give them significant influence over BTC and Bitcoin's ecosystem. Then again, history suggests that these institutional investors will fail. You can learn more about that using the link in the description. Now, in the sixth part of this report, the authors provide a prediction. A Bitcoin-based stablecoin will emerge this year. Some would argue that this prediction has already come true, given that Terra's UST was partially backed by BTC, and Tron's USDD is also partially backed by BTC. But let's not go there. Anyhow, the stablecoin that the authors have in mind isn't decentralized. Rather, what they envision is a centralized stablecoin that will launch on Bitcoin, like Tether's USDT or Circle's USDC. The authors note that this hasn't happened yet due to Bitcoin's technical limitation, as well as its performance bottlenecks. But the surge in innovation around Bitcoin's layer 2s and sidechains could open the door for a novel stablecoin that could work around Bitcoin's drawbacks. The authors argue that Bitcoin would be a popular destination for stablecoins due to its security. But it's important to note that layer 2s can be centralized. In any case, the authors believe that the launch of a stablecoin in Bitcoin's ecosystem will result in more innovation, integration, and ultimately adoption. Some would say that BTC doesn't need stablecoins to succeed, but then again, let's not go there. In the seventh part of this report, the authors analyze EIP 4844, which is tentatively scheduled to go live on Ethereum by the end of February as part of the Dencun upgrade. If you watched our recent Ethereum update, you'll know that Dencun will make Ethereum layer 2s cheaper and faster. The authors reveal that Ethereum's layer 2s will be between 10 and 100x cheaper because of the upgrade, and speeds will likewise increase by 45 to 100x. If we're not mistaken, this will make most of Ethereum's layer 2s faster than Solana, which could have a game-changing effect on market dynamics. On that note, the eighth part of this report is about, you've guessed it, Solana. The authors begin with a bold prediction. Solana will continue to eat into Ethereum's market share, specifically for DeFi and data availability. Not surprisingly, the authors include a couple of lines about Celestia in this section. More about Celestia in the description. Now, what's wild is that the authors argue that Solana will take Ethereum's data availability market share because of the complexities of EigenLayer's data availability solution, which are outside the scope of this video. The TLDR is that developers apparently find it much easier to build on Solana. This says a lot, considering building on Solana feels like chewing glass, according to Anatoly Yakovenko, Solana's founder. Incredibly, the authors go as far as to argue that EigenLayer's shared security model is similar to that of Polkadot's, which they claim, and I quote, has arguably not been successful. As for the DeFi competition, it's pretty straightforward. Solana is cheaper, faster, and its ecosystem has more entities affiliated with TradFi, such as Jump Crypto. These are solid fundamentals for DeFi. Conversely, Ethereum's DeFi ecosystem consists of less experienced players, or so the authors imply. And it goes without saying that Ethereum is much slower and more expensive than Solana. But if you watched our video comparing the two crypto projects, you'll know that Ethereum is exponentially more secure. For many experienced investors, the cost is worth this additional security and decentralization. Moreover, Ethereum continues to dominate when it comes to developer activity. As the saying goes, if you build it, they will come. Development activity is the focus of the ninth part of this report, wherein the authors predict that there will be a surge in 2024. This makes sense given that the markets will likely rally. It makes even more sense in Bitcoin's case, given all the aforementioned innovation. The authors note that there has been lots of developer activity on adjacent projects such as Stacks. Even then, the entirety of the Bitcoin developer ecosystem pales in comparison to Ethereum, which stands over 3,000 devs. What's fascinating is that the developer activity on Solana has been comparatively muted despite the recent rally. This could likewise be due to the fact that lots of Solana's recent development has been taking place on dApps and protocols, not on the base layer. What's insane is that the authors predict that Solana's core developer activity will explode after the Firedancer upgrade is implemented later this year. That's because it will apparently increase Solana's TPS to a staggering 600,000 transactions per second, which honestly sounds too good to be true. The only thing even more outlandish than a Layer 1 crypto with a six-figure TPS is the idea that hundreds of billions of dollars will flow into the spot Bitcoin ETFs in their first days. Lo and behold, fund flows are the focus of the 10th part of the report, where the authors make some extra juicy predictions. They begin by revealing that they already have been significant inflows into exchange-traded products for crypto late last year. They estimate the total assets under management of these funds to be $51 billion, which they note is quite high given the November 21 peak was around $84 billion. They take these sizable fund flows as evidence that the crypto bull market is here and it's only just getting started. They note that 87% of crypto fund inflows last year were related to BTC, which is not surprising given the spot Bitcoin ETF FOMO at that time. They predict that we will see a similar phenomenon of ETH in the lead up to the spot Ethereum ETF approvals, which are expected to occur sometime in May. So far, Sol has been dominating fund flows, which again makes sense, given that it was likewise rallying like crazy at the end of last year. Now, in the 11th part of the report, the authors do a deep dive into NFTs, and there's not really too much to note here. The key takeaway is that NFTs appear to be becoming a new niche of art and culture, which could grow to be as large as $500 billion in the next 6 years. Then, in the final section of the report, the authors review the regulatory outlook for crypto in 2024. They begin by celebrating the fact that G20 countries are working to regulate crypto instead of banning it. This makes us wonder whether they've actually read these regulations. If you've watched any of our recent videos about crypto regulations, you'll know that they're not all good. In fact, most of them are bad, as they defeat crypto's purpose. The silver lining is that they set the stage for better crypto regulations in the future, something that the authors are presumably aware of. Whatever the case, they predict that the UK's crypto regulations could be delayed due to the upcoming elections. They also note that the EU's crypto regulations will come into force soon, with restrictions on stablecoins starting in June. This means no more USD stablecoins in the EU, by the way. The authors also predict that one country, which is actively trying to ban crypto, will pass pro-crypto regulations instead, and include India, Nigeria, and Turkey on their list of possible candidates. As it so happens, Nigeria is already moving towards reasonable crypto regulations, allowing for banks to serve crypto clients. Finally, the authors predict that there could be some regulatory surprises in the US. These include a potential crackdown on another major crypto project or company, or a bombshell ruling in the SEC's ongoing cases against Binance and Coinbase. They hint that DOJ could also announce another crackdown. This brings me to the big question, and that's what all this means for the crypto market. The answer fundamentally depends on two things: consensus and awareness. Perhaps we're mistaken, but it appears the consensus is that crypto is only going to go up this year. That could be dangerous. You see, when everyone is bullish, chances are that's when you should be bearish. Conversely, when everyone is bearish, chances are that's when you should be bullish. It's the idea behind Nathan Rothschild's famous quote, "Buy when there is blood in the streets." The fact that so much of the market is bullish now could therefore foreshadow an unexpected shakeout, at least in the short term. However, there is another famous saying by John Maynard Keynes, and that is that the markets can remain irrational for longer than you can remain solvent. This means that the bullish sentiment and the bullish price action that we seem to see right now could continue for a very long time. From our perspective, this likely depends on how much money is sitting on the sidelines waiting to get in. That is, how aware the average investor is about crypto. There is no question that the spot Bitcoin ETF approvals have put crypto back in the spotlight, and it's likely that the speculation around the Ethereum ETFs could keep that spotlight shining. The only question is whether investors will bite. In the question of altcoins, this biting comes mainly from retail investors. As our friend Ben Cohen has pointed out on many occasions, a true crypto bull market is where altcoins rallies require marginal buyers, retail investors FOMOing in. So far, we haven't seen that much retail FOMO, which could be evidence to the idea that the current rally will continue for some time. But what if the retail FOMO doesn't come anytime soon? After all, the retail FOMO only tends to come when BTC, ETH, and other altcoins are hitting new all-time highs. Although we're not so far off those levels, it's not guaranteed that we'll see them in the immediate future. Without new money coming in, those sitting on massive profits from the rally that we've seen over the last year or so could start to take them. This could result in a short-term correction that delays the true crypto bull market. Former BitMEX CEO Arthur Hayes believes that BTC could correct as much as 30%. If it does, then it could very well mark the last chance to accumulate your favorite cryptos before the actual bull market. If it doesn't, then it'll be on you to figure out which cryptos with potential haven't pumped yet. Chances are that there will be a lot of them, so don't freak out if you miss the first ride to the moon. Okay, well that is all for today's video. If you found it informative, smash that like button to let us know. If you want to stay informed, subscribe to the channel and ping that notification bell. If you want to help inform others, then take a second to share this video with anyone you think should see it. As always, thank you for watching and I'll see you in the next one.